All right, good to see everybody here, guys. Students asked me to do a quick video on the different financial statements. This is kind of useful for year 11 and also year 12, but this is for year 11 student. Okay, so we're taking a look at, there are three key financial statements that we need to be aware of. They are balance sheets and cash flow statements. Now, cash flow statements sometimes are called cash flow projections, but a projection is looking ahead of what you would think might happen, whereas a cash flow statement is actualized, it's what has really occurred. So it's a slight difference, but just keep that in mind. And the final one we've got here is, it's got three names: an income statement, or a profit and loss statement, or it's called sometimes to a revenue statement. But profit and loss is probably the best definition about what it is, although you generally see the term income statement usually, as you can see in this example. Okay, and it will take a look at your profit or your loss for your business. Now, there's other little things that we look at too, like break-even analysis and those type of things, but I'm not covering that in this particular lesson. All right, so if I go through this here, in terms of your balance sheets, we've got here an important thing, which is called the accounting equation. Now, the accounting equation takes a look at the assets compared to the business's liabilities and owner's equity. Now, what do these three things mean? Asset is anything of value. If you could sell it and get some cash for it, then it's considered an asset. It's considered to be of value. And there's two types of assets. You've got a current asset, which is something that you generally turn into cash within a year time period. Or if it's already cash, well, that's obviously already been turned into cash because it's cash, then it's also a current asset. Is something that you rarely sell or rarely turn into cash, either never or something that's like a company car. You'd probably eventually trade up and get a new one, but you don't do it each year. So it's considered a non-current asset, yeah? So on the left-hand side, which is this accounting equation, you can see, you've got all of these assets, the short-term assets, the long-term assets, something of value, you plus them together and you get the total assets over here. Now, as this accounting equation says, the asset side needs to be equal to the liabilities and the owner's equity side, or the equity side. So you'll always see that this number here and that total down here need to be equal to each other, yeah? And the example I'm just going to give here is just a person's home, yeah? So if you've got a house that's worth $1 million and you've got a loan, which is the liability, is worth, at the moment, you took out a mortgage worth, say, $400,000, then your owner's equity, and let's spell properly, what's that equal to? That could kind of be the question. And if you look here, the accounting equation says your assets $1 million, yeah, based on this. Your double set of liabilities that's here, okay, will be equal to 400,000. So what's left over? That's the owner's equity. In this instance, it would be $600,000. And this kind of makes sense. Kids say, why does this balance? I don't get it, sir. Well, if you've got your house and you know that you could sell it for $1 million, if you pay off this loan of $400,000, what, you as the owner, what's the equity? What have you got left? And the answer is $600,000. Yeah. Now let's say you've got a rich dude, a rich lady, the loan's $0. Yeah. Then what would the owner's equity be in that instance? And the answer would be, if you sell your house and there's nothing to pay off, what's the owner's equity? What have you got left over? Well, that will be $1 million. Yeah. And that's why it balances. Okay. So in an exam, you might have, say, this missing, the 100,000. But if you know the rest of these and this answer, then it's just like algebra, basic algebra. What's missing? And it would be X. Well, it's 100,000. Yeah. Similarly, if you've got here 250,000 and you've got all of these figures and you've got 100,000 there, but you're missing retained profit. And if you know that's $250,000, then you know that that's 28,000 because it's the only thing missing. Yeah. So you might be asked questions around something will be missing from some side, or maybe this is missing and you know that that equals that and so on. Okay. So they won't take out this and that, unless they're saying what's the total current liability. Yeah? But I'll take out one part of these things, potentially. And you need to be able to use this accounting equation to figure out the answer. Okay. All right, so that again is called your balance sheet. And that accounting equation, assets equals liabilities plus OE, which is the equity, the owner's equity. That's the important thing to remember. It's got a balance. Okay. Now, looking at the next one here, we've got a cash flow statement. Now, remember, cash flow projections are usually forward predicting looking things. Cash flow statements, sometimes that language is interchangeable, but generally looking at something that's actually occurred. Yeah. So I want you to think here about this concept. It's your bank account, and it's the money. It could be electronic or physically. The lady goes to the bank, puts it in the bank. Okay, so it's electronic or physical. It does not matter, but it's money going into your bank and money going out of your bank account. So it's your bank account. What's in there to start with? Okay. Yeah. And cash receipts or cash sales. Okay, what's what goes in. And comes up with this, and what goes out, these cash outflows, cash payments, different names for it. But all of these things are things that have gone in, all the things that have gone out, and what you have in at the start of the time period. Now, sometimes you see things that are more detailed and not for so many months. It could just be for one time period, a yearly cash flow statement. Okay. So who knows what you're going to get in an exam, but for the HSC, you tend to get these things. So let's figure this one out. You start with 4 grand, 12 grand goes in. What's in your bank at the moment? 16,000. Now, if $8,000 goes out from the $16,000, you're left with $8,000. Now, I hope as I'm going, I'm not making an error. Highly likely I will. Now, whatever's left in the last second of January will also be the exact same second at the start of February. This here does not change from there. Now, sometimes you're just given these two things. And in fact, from the textbook or the exam, previous exam I was looking at, it only had these two columns, or these two rows rather. So I just added these to make it a bit more easy to explain. Yeah. Now, if we start on February with $8,000, we get $11,000 of sales, receipts, inflows, whatever you want to call it, come in. We've now got 19 grand in our bank. Then 5 grand goes out. So 19 minus 5 is 14,000. Now, if you notice I make a mistake with one of these little maths and the whole thing will be out, that's fine. I want you just to get the concept. If this is 14 grand, well, of course, 3 seconds later, end of this month, start of this month, still 14 grand. Well, we start March with 14,000. We got $7,000 coming into the bank. That's $21,000. And we have $6,000 going out. So 21 minus 6. End of the month, we've got 15,000. Here is obviously 15,000. Whatever's there will be there. Start with 15,000. 5 grand comes in. That's 20 grand. 6 grand goes out. We're back to 14,000. Start here with 14,000. We already established this. Now, the only thing I'll say is this is an unusual question that you generally get. I'm going to go and change a few things here to make it more realistic with what we would probably have here. Let's say there was a big bill this year. This is more realistic. Yeah. So if you've got 15 grand at the start of April, if 5 grand came into the bank account, you've got 20, then 20 grand comes out, well, you've now got 0 in your bank account. This is not a huge problem yet, but it's pretty close to it. Yeah. The problem will be here. If you've got $0 in your bank account and you get 3 grand in during May, that's $3,000. But you're now losing $8,000 coming out of the bank. All right. Now, guys, so let's do this first. So 3 minus 8 is minus. And often we do brackets for minus. Okay. Minus $5,000. So the purpose of a cash flow projection or statement is to be able to look at times when you're likely to have negatives. And then as a result, then you'll see that you need to put in place a strategy to be able to address that. It could be get an overdraft or to be able to get a credit card or something so that can tide you over that period of time. Or there's a thing called distribution of sales, whereby you can try and space out these big bills throughout the year. Okay. Now, what else was I going to mention here? I think that's pretty much it. Okay. So keep in mind here, guys, what are the purpose of these financial statements? This purpose is not about profit. Kids always talk about profit. It's got nothing to do with profit. It's to do with liquidity and having enough cash on hand to meet your needs. Okay. So I want to hear you talking about profit with this. It's liquidity, yeah, and cash in particular. All right. Now, whereas the objective when we look at this, and this is more for year 12 students, we're often talking about things like liquidity, as we talk about assets, current assets compared to current liabilities. And this is not something year 11 kids need to really know. Okay. And we're also looking here at solvency because we're looking at debt compared to equity. Again, that's a year 12 concept. So year 11 students don't need to worry about that. Now, if we take a look at the final financial statement, it's got three names, as I said. This is what we usually see as the name. But to be honest, this is something that's more appropriate because it looks at your profit or your loss. Now, when I set up here, I don't want to hear you talking about profitability here because it's not. It's about your liquidity. Do you have access to cash at hand? This thing is about profit or about loss. Yeah. So if we're taking a look here, we're looking at 3 different year periods, but often they'll look at just one particular year. Yeah. So let's sort of go through and have a little look at what it looks at and what it does. It looks at how much sales or total revenue, which is not profit yet. It's how much sales you make. Now it is the number. So let's say we make 1,000 sales times the price at which you sell the item. So price times quantity. All right. So if they sold 208,000 pens, this business, they sold them for $1 each. Well, that's their sales. Yep. Not their profit because there's all these other expenses, but it's their sales revenue. Now there's a thing called Cogs. Now what's Cogs? It's not here, but in year 11 more so you need to often figure this out. Here's the little formula to figure out your Cogs. It's your opening stock plus your purchases minus your closing stock. Yeah. In year 12, they assume that kids already know this. So they often just give you, like they have here, the answer. There's Cogs. For the next year, Cogs. And for the final years, there's Cogs as well. Yeah. All right. What does Cogs mean? It's the cost of goods sold. So put simply, if I'm a canteen and I'm selling purely, ice blocks, how much did it cost me to purchase those ice blocks? If there are 1,000 of them and they cost me $2 each to purchase from my supplier, then Cogs is $2,000. That's what it's talking about. If you don't understand that, it doesn't matter. You just need to understand how this works. So to figure out the first type of profit, which is called your gross profit, you simply need to do your sales, which is here, 208,000. So let's do this one for this one, 208,000 minus your Cogs. Again, it did it for you. So for this one, you don't need to figure it out. It is 96,000. So gross profit in this instance for the 2008 year is the sales minus the Cogs. That's 112,000. That minus that. Okay. All right. Now, netty. That's French. Very fancy. Net profit is the final thing you need to sort. Now, how do you find out your net profit, which is the more accurate detail of how much profit a business makes? And you pay tax based on your net profit. Again, you don't need to really know these things, but for university and things, it's good to understand it. So to figure out your net profit, you do your gross profit, and then you minus all of these other expenses. Now, see how it's got total expenses here? They made it easy for you. You don't even need to go and plus this, and this, and this, and all these things, because the 83,500 is all of these things. Okay. Sometimes that's included. Sometimes it's not. Sometimes they've even got subtotals. with the financial expenses in a separate column. Sometimes they've also got subtotals of the selling expenses. So they would have these two plussed up in a subtotal. So you need to be aware. This is why I say do lots of questions. There's lots of different ways to kind of present these statements. And if you look at lots of different ones, you'll get better ideas. Yeah. But let's get back to this at hand. How do we figure out net profit? It is real simple. It is your gross profit, 112,000, minus your total expenses, in this instance, 83,500. So I'll write it down here. Again, it's the gross profit. There it is, minus the net profit, minus the, all other expenses, which are the total expenses, 83,500. And that arrives us with the figure for the net profit for this business in 2008 is 28,500. So that's our final profit. Yeah. And you look at things like trend analysis. Is this good, or you need some context? You know, it's okay, but it was not as good. You know, is this okay is probably a better question. Well, it was a good trend here, and now it's starting to get worse. Yeah. All right, guys. So there is more detail for year 12, but hopefully that gives you some assistance for year 11 at figuring these things out. If you've got any questions, please leave a comment and I can answer that. All right. Thank you very much. See you guys later.